Maddie from FX Scouts. So in this video, I want to talk about a trading mistake that I used to make very frequently, and that was to trade false breakouts. Now, it's a very common mistake and it's very easy to make, but there are some confirmation signals you can look out for to avoid these fakeouts. In this video, I'm going to be showing you how to identify different breakout patterns, what confirmation signals you need to look out for to ensure that the breakout will indeed occur, and then what to do if it doesn't. Before we jump in, I just want to show you what patterns you need to look out for a good breakout opportunity. So a breakout occurs when you have strong support and resistance, and you have multiple key rejections of both. That's very important. So here you can see that price was trading in a range, making lower lows and lower highs. The actual breakout happens when the price bursts through one of these levels. What you'll also notice is the confluence of other signals. So in addition to the breakout, it breaks above the 200 EMA, and the blue MACD line of the MACD indicator crosses above the orange signal line. And notice what happens when the price does break through. It starts soaring. I want to show you some typical breakout candlestick patterns that you can look out for and that are very easily identifiable on your chart. So there's the wedge and the flag, both of which I've described in videos before. Then you get the rectangle, the triangle, and the pennant. So you're not looking for the exact replica of the price action that you'll see in these images, but you are looking for key support and resistance levels that basically form these different patterns. Now, to be honest, you don't even need to know the names of these patterns. You just need to recognize that price generally consolidates. And once it consolidates, whether it's consolidating to the upward side, whether it's consolidating downwards, or whether it's going sideways, you will always see a breakout after consolidation. That's the way the market works. And the more the price consolidates, the bigger the breakout you might anticipate. So then what is a false breakout? Well, a false breakout occurs when the price does break to the top or the bottom of these levels, in other words, above resistance or below support. But what then happens is that it doesn't have the momentum or the strength to carry on up or down, depending on which way it's going. And so what it does is that it goes back inside the pattern or back between the two support and resistance levels. So in the chart here, you'll see that the market formed a wedge pattern, and as the consolidation became tighter, the market broke to the upside, but it could not maintain enough bullish momentum to hold above the level. In other words, the market lacked the demand to push prices higher after the breakout occurred. So if you had entered long as soon as the market breached the resistance level, you would have been caught in a false breakout. Now, once you're on a trade like this, you're confronted with two decisions: either stay in and ride it out, or exit for a small loss. I would exit for a small loss, but neither of these options sound very appealing, and in fact, riding it out could lead to very big losses. To avoid this happening, you need an additional requirement in your trading plan. As I often talk about, you need a confluence of factors or confirmations in order to take a trade. And in terms of breakouts, the confluence comes in the form of a momentum candle. So momentum candles can take many forms, but usually they're one big candle with a large body or three medium-sized candles all going in the same direction that close above the resistance or below the support. So it isn't enough for the market to simply move above or below a certain level. You need the candles to close above the resistance or close below the support in order to identify a true breakout opportunity. Okay, so in this example, we have a set of multiple higher highs. So we can set a resistance level right here. Then we have a key support level right here because the price reverses numerous times at this level. It is also above the 200 EMA. So now we wait. We see a decent sized candle form or a momentum candle that breaks the resistance level. The problem is that only the tip of it broke out and it doesn't close above the resistance line. So we don't count this as a momentum candle. To count it as a momentum candle, most of the body would have had to break above the resistance level, and it would have to close above the resistance level. Also, we'd like to see a green candle form after this one, but unfortunately it was a red candle instead, so we ignored the signal. And thank goodness we did, because look what happened. It was a false breakout. I want to show you another example because I feel like when you see enough examples, you'll start to be able to identify these examples yourself on the charts. Okay, so here we have support and resistance levels set up. The price moves and it is above the 200 period EMA, which is important because, as I said in the previous video, it can act as a strong resistance, making it difficult for the breakout to occur. You see that a decent sized candle breaks through the resistance. It's not a momentum candle because it does not have a big body, so we wait for further confirmation. A second candle appears, but it's still pretty small. And as we said before, we'll only count it as a momentum candle if it has a huge green body that breaks above and closes above resistance, followed by another green candle. So we wait again. Then a third green candle pops up, which is a very bullish sign, and so this is when we enter the trade. Then I set my stop loss right below the resistance level. This way, if there is a pullback and price does reverse for a moment and pulls back to bounce up again, it won't hit my stop loss level. Or if the price goes straight up from here, I'm in the trade. Considering this candle right here is a momentum candle, it's very unlikely that this is a false breakout. But in case it is, I still have a stop loss in place. Now that we have our entry, we need to figure out an exit strategy. And with breakouts, they tend to make large moves very quickly. So if we use our usual 1 to 1.5 risk reward ratio, we might actually limit our profits. What I like to do is I like to use the two-step profit system, which protects my profits, but also ensures that I could earn more. So you'll find your entry signal, then put the stop loss below the resistance line, then set your take profit at a 1.5 ratio. Once the price hits our take profit mark, we'll sell half our position to guarantee that profit. It's also known as scaling out of a position. The other half will stay in the game. Then our next take profit will be determined by the same 1 to 1.5 ratio. If we'd sold the full position at the 1.5 mark, we would have missed out on a lot of upside. I really hope you found this video helpful. I know this has really worked for me in terms of avoiding false breakouts. If you have any questions, please don't hesitate to contact us. Our website is fakeouts.com. And please remember to subscribe and like. It means that we can continue to make more free videos like this, and we can continue to support each other on our trading journeys.